Are you an agent struggling to understand real estate economics? Would you benefit from learning how top agents structure their businesses? Then you've come to the right place. And welcome to the Nerdy Agent Podcast, where we teach you the basic economic and business principles you need to thrive in today's real estate market. You were early on the point, AJ, today.
I was not.
I'm your host, Luke Pettersen. With my brothers and fellow nerds, AJ and Josh. What's going on, guys?
Yo, I don't know what has slowed more quickly, the buyer activity here in the market or the freaking temperature.
It's really cold here.
It is awfully cold. We were just out actually last week. Luke and I, AJ had a 10th anniversary trip instead.
So he was in the warm in Tennessee, though, too.
Yeah, but we were out in Vegas, and so we got to see both EXPCon, which was awesome, as well as Zillow Connect, as our partnership with Zillow is a big deal to us, too. So we enjoyed some awesome meetings, but also some awesome weather at like 90 degrees and came back to the 20s. So it's been interesting to kind of watch it all play out.
Yeah, it was phenomenal. And we actually just rolled out our new integration between Follow Up Boss and Premier Agent yesterday that we're meeting with the team after this about.
For those flex teams out there, this is exciting news.
It is pretty amazing. I don't think either of you have seen it yet, but I was messing around with it yesterday, and it's pretty incredible.
Love it.
Anything that makes us more efficient is good.
Getting into the Would You Rather of the week, we went with the temperatures because we were in Vegas and it was warm and it's cold now. So the question is, would you rather show a house in negative 20 degree weather, that is with wind, make sure we know, so like the wind is also cold on your face, or...
But what's the wind chill, Luke?
The wind chill is negative 30.
Do you like we always look for like different ways to beat these questions?
Yeah, exactly. Show a house in negative 20 degree weather or 120 degree and humid weather.
Does the house have central heat and central air?
Has it recently
recently
snowed or icy rained if it's cold?
There's definitely snow on the ground.
There's snow on the ground. Okay. Yeah. The question then I would propose as a response to this is,
there is no question to be asked.
Is it a Supra EK or is it a Master Lock?
For all the non-agents listening, they just turned off this podcast.
You don't know.
That's you won't tough, know because the Supra E-Key is not going to work. My fingers are going to be falling off.
It's also a 1977 lockbox that's got just the weird push buttons that get stuck all the time.
Yeah, you have to like hit it with your hand. I once brought one of these into my car and put it up against the heater to heat it up to melt the ice off of it so I could open it.
Yeah. But that wasn't the Supra. The Supras have always worked for me personally.
No, they'll glitch out like 6 times. When it gets below 0, they don't work.
If we're thinking about only the temperature,
so I'm picking.
Which would we choose?
All right, you guys go first.
I pick hot.
I want hot all day.
I picked hot too.
Hot all day.
But why is your? Well, one, we actually do show houses in like negative degree weather here in Minnesota.
Worst.
It's awful opening that. My fingers freeze every time opening those stupid lock boxes. The other thing that I'm gonna throw out there, if it's 120 degrees, you can drive to the place in 120 degree weather, which my car has air conditioning, so that's actually not that bad to be driving around in 120 degrees. Driving in the snow and the cold and it's so bad.
Unless you're a truck guy.
It still is not
your
fun.
Car handles. However, if you don't turn your car on 20 minutes before you leave the house and the drive is less than 20 minutes, you will be cold the entire drive.
I do have heated seats, but still, it's not.
They still take 5 minutes to heat up.
It's tough. I agree.
Not very fun. Let's get off of
our Arizona friends are like, you guys are crazy.
Yeah.
Absolutely crazy.
It gets hotter than that sometimes down there. They were telling me in Vegas it got to like 130 real feel sometimes, which is just madness.
It's hot. They have pools.
Today we are going to talk about showing activity graphs, how you can track them, what they mean, and why you should care. So just to get started with the bare bones, tell us what they are and where people can track them.
Yeah, so we look most closely at the showing time index, and these are actually available on Showing Time's website. They have the one we tend to look closely at because our Minnesota one, for some reason, isn't working properly right now, is the Midwest one, but they do have them broken up by region. They do have some specific state graphs as well to show kind of how showing behavior has changed. The biggest thing that the Showing Time Index does is it looks at residential showings per residential property and scores them in comparison to where showing activity was in January of 2014. The January of 2014 components, it's a little strange, but it's just setting a baseline for the index. But really what this index does is gives you a really good apples-to-apples comparison of how we're tracking versus other months within the same year, because you're comparing the amount of showings happening versus another time frame, and year over year, because as in Minnesota, we tends to have a lot of seasonality. And so it kind of gives you a good sense of how many people are out looking at houses.
And just so we explain this too before we get any farther, showing time is the primary showing where you schedule the showings for agents here in Minnesota. I think some markets don't have it, but the majority do.
It's like 95% of markets are working
almost
on
all of them do.
Owned by Zillow now.
Exactly. There you go.
Closed a month ago.
And so the data on that Showing Time website is pretty dang accurate because the majority of the markets are using it to schedule the showings. And why should agents care about paying attention to this and following it on a weekly or monthly basis?
Well, first off, like for those who don't understand indexes, an index is, like Josh said, it's based on usually based on a certain point in time that they mark as 100. A lot of times, the affordability index being a little bit different than that. But a lot of times it is based like this. So Josh said it's kind of strange, but they started it in January of 2014. So everything just compares to January of 2014 when it was 100 as the benchmark. So when we say it's 200, that means it had twice as much as January 2014. The nice thing, like you said, is you can compare 2 months based on how they compare to that January 2014 number.
The goal is always to take a complex situation and break it down into very simple numbers that you can compare one versus one in a completely similar way.
Exactly. So, it basically the Showing Time Index gives us like a really good perspective on the health of the demand in the market. So right now it's 154. A year ago it was 168. 2 years ago it was 179. I believe those numbers are for September.
Yep.
So it's slowly decreasing, right? At a 5 to 10% clip on each year. What's crazy, which again shows seasonality in Minnesota, and for those that aren't from Minnesota, they may not have the same impact. But here in Minnesota, we pretty much bottom out December, January in activity, and we usually peak late spring, early summer. This year, given the rates that we've talked about many times on the podcast before, we peaked at 306 in March. So we have almost halved the number of showings or the showing activity and demand in our marketplace since then, which is pretty wild. That's
306 is the highest it has ever been. So that's the only interesting thing. It's like we've gone down 2 years in a row, right? But if you go back 5 years, the 154 is actually kind of a high number still. So this market is so unprecedented in that it feels really slow, but it feels really slow partly because it's been so insane for the last few years that 306 number was just off the charts.
So I was going to say, because the benchmark of 100 in 2014 was kind of when the market had already came back from the recession, right? It was pretty healthy at that point.
Market was great then. That was right when I got into real estate. It was a little bit after that.
And so we're still compared to that standpoint, we still have more showing.
It'll be interesting to see like this January of 2023 what the number is when you compare the two.
Yeah.
Because that's just comparing to that January. But yeah, no, it's a good point. And we could look back in 2014 and kind of see where those numbers were. I think the interesting thing too, if you broke it down further, is what do we think? And maybe you guys have different opinions. What do we think we're seeing in terms of the number of showings per client right now? Has that been changing? That 306 number may be even crazier than it looks because a lot of buyers weren't looking at one or two. A lot of buyers.
I gotta buy a house. We gotta go buy a house.
Houses before making an offer.
But if you lost, you had to keep looking.
That's true.
And so if you're in multiple offers, you're almost seeing more.
But my guess is showings per client are up right now because buyers are far pickier. Even though they were losing before, I have a lot of buyers like, we'll see some more. We'll see some more. And so you're seeing more showings along
I just
board.
thought it's interesting conversation.
I'm struggling to. I would almost have to go back and look at each of my clients, but I kind of feel like they're down right now because I see it more from not how ready to buy they were, but more how now. I was just with somebody yesterday that showed them one place, and I had not shown them a house in a month because there's no listings.
Yeah.
Like there was nothing available. And so I've shown them a decent amount of places, but it's not as many as I would have shown someone back in March because it was like, we went out and saw 3 offered. If you lost, you went out and saw 4 the next day.
Yeah.
Mm-hmm.
I think we just found a nerdy agent gap on air live here, which is we are not tracking number of showings per client within our data. So maybe we're going to start having to do that. Just track how many showings we're doing per client.
We need to be better.
Data.
Be better.
Yes. All right.
That is interesting thought,
Note
though.
taken.
Yeah.
Maybe Jason can help us.
Yes.
And I think one of the other interesting points about this data too is the breakdown between the different price points. So, maybe a first-time home buyer price point versus a step up versus kind of the more luxury market. Tell us about kind of what that looks like.
So, across the board right now, showings are down. So we talked about this, right? We're seeing both the combination, and to AJ's point, of the interest rates hitting the showing activity in general. Buyer demand is just down. On top of that, we have seasonality, which is kind of double dipping our numbers down, but we are seeing showings down year over year. When we break that and split that out into price points, so what I tell you is at the higher end price points, showings are down less than they are at the lower end price points. Inherently, this makes sense because you'd think that if you're a first time home buyer, you might just rent for another year. So you're just kind of falling off the market.
Or
when
you get
interest rates
priced
went up.
out.
Or you get priced out, but because affordability, which
Yeah.
reminder to go back to the affordability index podcast. But either way, it's a little misleading because the flip side of this is that our inventory is also way down in the lower price points. So there's definitely fewer showings happening in the lower price points, but if there's less inventory, it's hard to say if there's fewer buyers or if they're just nothing for them to see, the ones that are kind of considering buying at this point.
And that gets into kind of our next question. So we do know, there's less showings right now than there were in March, and let's just talk about the whole thing opposed to price points. How does that correlate to the amount of homes? You kind of touched on it.
What would be fun, I think, too, though, just as a little caveat, would be to overlay the amount of mortgage applications with the showing time index and see what that looks like. Wouldn't that be cool?
This is like a live on air brainstorm. This is
we
good.
We should do that. We should do some
another note taken
brainstorming.
Mortgage News Daily.
Ideas.
Speaking of overlays, though, they do tons of super cool overlays to show like how one thing's impacting another thing. But yeah, an overlay of mortgage applications and showing time, and the lag period on it too.
You could overlay.
It will probably be a couple months.
Yeah,
you could overlay mortgage applications, the showing time data, and new listings inventory.
You could see, and you could see that'd be
where
kind of
the
fun.
correlation is.
Anyway, you can ask the question.
Homes
Josh.
available. What's the correlation between the showing time graphs and homes available that we're seeing in the market? You already touched on it.
Yeah, I mean, fewer homes available means fewer showings, right? Because if there were 0 homes available, we'd have 0 showings. That said, we've been at historically low inventory levels now for last year, 2 years, right? So when we hit 306, which is an all-time high, we were still at historically low inventory levels, right? We actually have more inventory now than we did probably in March. So the correlation is still pretty significant that if you have a low showing time number, if the buyers are hungry, they're going to go out and buy a house, I guess is the point. So they're going to be seeing homes, they're going to be getting after it when the rates were low and when the market was crazy. And buyers were just squeezing themselves in the houses that may not have been ideal. So yes, in theory, you'd have fewer showings as fewer houses are available. But what we've seen also is that if buyers are hungry, they will get out and see houses.
This is that weird stat that you show sellers right now that I'm trying to advise properly on, but it's very difficult. Which is it's a combo stat that is combined via our MLS data and the showing time data that goes into InfoSparks. I'm not sure if that's a national thing, but in Minnesota, it's a great tool to have. Is the shows to pending, which is always a funny one because if you were to look like back in the spring, the shows to pending was like super high across the board everywhere.
Because so many people were showing the houses.
So, but it doesn't mean that it was on the market longer. It just meant that a lot of people went and saw it the first weekend.
Yep.
And now it's much lower, which doesn't mean that they're selling faster. It just means there's less buyers out there. So it's really interesting to look at some of these stats and actually unpack the data without having something that's super clickbaity. So that's an interesting one too. That kind of is to this point.
When I was just thinking too, you would think actually that the showing time, how many showings are happening, more maybe correlates to the amount of new listings hitting the market versus inventory. Because even then, you'd say there's a ton of showings, and that would think that inventory is low, so there shouldn't be a ton of showings. But inventory is low because stuff was turning so quick. Yeah, house go on the market on Friday, it's sold on Sunday, but they showed it 30 times.
Pendings were way up.
Exactly.
Yeah.
So there might be correlation there as well.
Yeah, and not to say I think the biggest thing to kind of explain what's going on right now, and not to oversimplify because I think everyone kind of understands this, but interest rates have thinned out the buyer pool, right? So as interest rates are now over 7, the buyer pool has thinned out, which we talked about in depth last week. And sellers have also slowed down coming to the market, to your point, right? Because it's not as appealing to sell as it was in the spring. So if you're saying, I can stay where I am, I'll probably just stay where I am. So you've essentially created just a stagnation point right now where sellers aren't coming to the market because either they don't want to become buyers or they don't like the way the market looks for them as sellers. And buyers that are first-time home buyers aren't really that enthused about coming to the market because of affordability. And so when we talk about being better, we've talked about this a lot of times, but in the next year or so, it's just going to continue to kind of be stagnant until we get some clarity around where interest rates are going to settle and some sort of return to normalcy in terms of just the macroeconomic environment that we're in.
And I actually want to, not on the list of questions here, but I think a good one to talk about would be and I know nobody knows what's going to happen, but for the past 3 years, when we hit Q1 of the next year in January and February, it became absolute bonkers. from a buyer demand standpoint.
Within our local market.
Within our local Twin Cities market is kind of what historically has happened. And I talked to somebody last night was saying, well, is there going to be more listings in the new year? And I said there might be, but if there's more listings, you might also see a ton of buyer demand come up. Like, what are you thinking as far as predictions go? Is it going to stay about this same? Is it going to see more buyers entering the market at that time?
We've been told we need more debate, so we'll see if we debate this.
Ask me in 2.5 weeks.
Yeah.
I'll give you my answer. Once the elections happen, this is historically, and this is not a political view, this is literally just historically how the economy reacts. Once an election happens, and leading into an election when we're likely in a recession and there's a ton of uncertainty.
Yep.
There's a war going on in Russia and Ukraine, and like there's a lot of uncertainty.
Interest rates continue to move, CBI's all over the place.
Nobody knows what's going to happen, right? Politically, there's also uncertainty. What's going to happen next, right? Are the Democrats going to continue to hold all of the 3 branches? Are the Republicans going to take over one of them? What's going to happen here, right? And what you see is once that happens, specifically if there is a split Congress where Republicans hold one and Democrats hold the other, the traders start to trade and they go, this feels more certain now. Nothing's going to happen. They're not going to pass anything. There's going to be no tax legislation. There's going to be no regulation legislation. Nothing's going to change. I know what's going on. I'm more certain about it. And if that happens, you may see that trickle down into interest rates. These inflation numbers start to come down. Things start to get better. And on the other side of it, that could line up nicely with the new year, late winter and spring.
It could. That said, a lot of this, in my opinion, is completely dependent upon how the interest rates settle.
100%.
So if they continue to have numbers, to AJ's point on inflation, and the overnight rates in terms of where interest rates are going that are uncertain and are going up, then going down, then going up, then going down, I think buyers will look at that and go, I don't understand what's coming, so I'm not going to do anything. And sellers will look at that and go, I don't see a lot of buyer demand, so I'm not going to list my house.
I also, by the way, have a 2.5% 30-year fixed interest rate on my current house, so why would I sell it?
We talked about that, right? 40% of people are under 4%. So we have it's a very difficult market to predict, but I personally don't assume that Q1 just happens and everything just goes back to normal magically.
No.
I think interest rates have to stabilize in a manner that everyone goes, okay, this is the new normal, before people are like, I will come back out now.
Yeah, certainty. I think certainty is the main thing we're looking for.
I mean, we've talked for a while that we're going to need some sort of flattening of the interest rate needs to stop somewhere for the certainty to, like, it can't just keep going up every month because the buyers will continue to pull back is kind of the idea. Yeah. As long as it just stops somewhere and hangs tight.
Keep an eye on the 10-year treasury yield.
Exactly. Yep. Not to get too off basis here, we are still talking about showing time and the data on showing time. I want to talk about how you can use it. So if you're tracking this weekly, monthly, whatever that is, how can you use that in, let's say, a first meeting with a buyer consultation to show your buyers what to expect from the market?
I mean, you can talk all you want about what's happening, but it is nice to show somebody something sometimes. Mm-hmm. So we've talked about doing buyer presentations and including a slide in the presentation that says, hey, look at this. The demand was this back then and it's this now. The rates suck, but you are in an environment that's, maybe a better situation for you. Specifically, I talk about this with low down payment buyers that need closing costs. I say, hey, I know the rate's 7% and all your friends maybe bought and they got 3%, but you weren't even allowed to participate in that market. So this is a better market for you just by default because you couldn't buy a house 6 months ago and now maybe you can. So, maybe your rate's going to be higher, your payment's a little bit higher than you thought, but look at this index, it was 300, now it's half that. There's space for you in the market now, and you can explain that to people about how demand has cooled and not say demand's way down, so the prices are dropping, but at least just use it to say, hey, there's room for you in the market now.
And I think we talk about all the time with our team about expectation setting for all of your clients. So we're talking about buyers now, but it's really important for sellers too, right? Yeah. I have a listing coming on Friday and I spent a lot of my time for the last 2 weeks prepping that seller for what they're going to expect when they come in the market. This listing probably would have been gangbusters a year ago, but right now I'm like, I don't know. Like, interest rates are high. I don't know if you're going to get your price. I know you want your price, but the reality is the market right now is different than the market was. So just be prepared for what is to come. Same to AJ's point is the case for buyers. So we sit down and we have very clear expectations that we outline. One of my favorite thing in our presentations is what to expect, right?
That one.
and we talk about the market. So if you're a buyer, we were like, be ready for multiple offers, be ready for appraisal gaps, be ready for inspection language, all of these things.
That slide is no longer on my buyer page.
I've changed it.
Yeah.
It's just called what to expect, right?
Yeah.
And I talk about in the spring, I would have told you this.
Exactly.
Now, these things aren't being seen as often, so you should know you may have some more leverage in the process as a buyer now.
Mm-hmm.
Vice versa for sellers. You should know you're probably not getting 4 offers the first weekend like you were back in the spring or last year, whatever. So expectation setting is really important. And using these statistics to basically back up the expectations that you're putting out there for your clients is the way I would think about it.
I don't want to get too redundant in this one. We are a little bit. But we want to get into the script of the week. Those themselves could have been used as scripts as well, which were really good. But this week, you're golfing on the last good weekend. Which
I thought we were bowling.
I thought we were doing hang cleans at the gym.
Yeah, what about the gym?
For those, we did talk about the cold. It will be 65 degrees this Saturday
AJ's going to give this script while doing push-ups, just so ready to know.
That would be you, Josh. You're the one who can do the
I was
push-ups.
gonna say, if it's 65 degrees, I'm going to be in my kayak fishing.
There you go, exactly. But you're out golfing or doing something that you like to do on the last good weekend in Minnesota before it's going to be
Have
cold
fun finding your
6
golf ball
months of
amongst the
winter.
leaves.
Yeah, seriously.
And your friends look at you and go, hey, it looks like the market's been down. That's what everybody's telling me. Prices are going backwards. Market's down. What's it looking like? How can you use the showing time data to be an expert opposed to generic, oh, there's no demand, prices are going
Buyers,
down.
it's cool, but you're a buyer, so you have all the leverage
Exactly,
now. But
yes.
you could also be a seller because it's always a good time.
But we
to
gotta
sell.
use
I
showing
would start
time.
with a joke question and say, oh, where'd you find that clickbaity article?
Yeah.
And they'd say, like, Yahoo Finance, CNN, Fox News, whatever they find, right? And
Way to use all 3 options there. That's good.
Lots of good options there. And I would first off respond with, yeah, prices are going down. But did you know that every year this time of year they go down? Did you know that they went down last year at the same time?
If you buy a house in May in Minnesota and then you sell it in that same November, you're going to lose money every single
from a
year.
macro from a macro perspective.
Doesn't
Yes.
go
well. Yep.
So they do go down, and they've surprisingly slipped by less than last year so far. That being said, demand has halved based on the index that we see from Showing Time. Showing Time's the application that we use to book all of our showings, so they have lots of really great data. And demand has gone down, but we don't see what the clear outcome of this is going to be yet. So we're tracking that closely, and we are tracking the prices closely. But until month's supply increases to a point where we see that there's an even balance of buyers and sellers, it's still a seller's market.
That's beautiful.
That's the script of the week. And that is all we have for you today on the Nerdy Agent Podcast. And remember, be better.